Are you repeatedly losing and gaining money by trading based on gut feeling? Or have you tried copying trading strategies from YouTube videos introduced by various YouTubers, but found that consistent results are not appearing, leaving you frustrated?
That's right.
Most videos on YouTube are just trash indicators created to make content, with false strategies claiming 80% to 90% win rates. I started trading in 2013 and continued until 2017, constantly cycling through winning and losing. I tried everything from renowned trading books to paid courses by self-proclaimed gurus, and those high win rate strategies plastered all over YouTube. I sought information everywhere from baby pips to TradingView community forums, desperately trying to find the magic formula. In those early days, I would trade purely on gut feeling, often risking over 50% of my capital in a single trade. In the futures market, I'd use leverages exceeding 10x, riding an emotional roller coaster where my mood would soar and plummet with unrealized P&L. My portfolio would spike and crash, mirroring the wild swings of my psychological state. But then I discovered something that completely transformed my approach. After understanding this key principle, I began developing my own trading method that allowed me to generate consistent, stable returns. Traders who consistently make money in the market know that trading is about this. And this is statistics. Statistics? If you're thinking it sounds complicated and you can't understand, don't be scared at all. Simply put, it means winning more often and losing less, or winning bigger and losing smaller. This is what trading calls win rate and risk-reward ratio. Now I'll teach you how to actually calculate the win rate and risk-reward ratio of a trading strategy. If you're in any signal group, you can calculate the win rate and risk-reward ratio of the provider. Calculate both using at least 30 recent trading records, and the more, the better. For win rate, divide the number of wins by total trades. For example, if you won 18 out of 30 trades, that's a 60% win rate. If you won 12 out of 30, that's a 40% win rate. For risk-reward ratio, divide average profit rate by average loss rate. If your average profit is 20% and average loss is 10%, you have a 2. Risk-reward ratio. Just knowing this allows you to objectively analyze trading strategies and determine the optimal investment ratio. Now, you might be wondering how to use this win rate and risk-reward ratio to identify a profitable strategy. This secret profitability formula is something I created, so you won't find it online. If win rate multiplied by average profit rate minus loss rate multiplied by average loss rate is positive, it's a profitable strategy. Let me provide a clear and engaging translation that breaks down the trading strategy explanation. Trend-following strategies typically have a higher win rate compared to their risk-reward ratio, while counter-trend strategies tend to have a higher risk-reward ratio compared to their win rate. Let's break this down with concrete examples. For a trend-following strategy that has a 55% win rate and 1.5 risk-reward ratio, the calculation is 0.375. For a counter-trend strategy that has a 40% win rate and 3 risk-reward ratio, the calculation is 0.6. The result is positive in both cases, indicating a potentially profitable strategy. The key is to consistently trade using the same method and meticulously record your trades in a trading journal. Conversely, let me provide examples of strategies that do not work. Before that, this channel was created to help anyone speedrun from beginner to professional trader through education. If you don't want to miss the next video, subscribe, like, and turn on notifications. We'll look at a strategy with a 70% win rate and a 0.25 risk-reward ratio, and another strategy with a 10% win rate and an 8 risk-reward ratio. These are typically the high win rate strategies and sniping entry signals found on most YouTube channels. In the first case, 0.7 multiplied by 0.25 minus 0.3 equals minus 0.125. For the second strategy, 0.1 multiplied by 8 minus 0.9 equals minus 0.1, which means both are not profitable strategies. Conclusively, most extreme high win rate strategies and sniping entry strategies typically do not generate profits. This approach transforms trading from a game of chance to a systematic, data-driven process. By understanding and applying these statistical principles, you can develop a more reliable and predictable trading method. Now, if you're trading or following signals, you can check the win rate and risk-reward ratio to determine if the strategy is profitable and decide whether to continue with the same strategy or develop a new one. Trading is not a gambling game hoping for a big win, but a skill of creating compound returns by accumulating profits and losses through consistent statistical analysis. Unfortunately, most videos uploaded on YouTube are fake strategies created for clickbait without considering the underlying principles, and these videos have wasted the time and money of many people. In conclusion, if you want to make money through a trading strategy, first evaluate it using the secret formula about win rate and risk-reward ratio, and then consistently execute your trades. In the next video, I'll be returning with content about risk management.